All right, well, let's go ahead and get started. Everyone that's here live with us, thank you very much for coming. We're excited to roll out our new simulcast platform for everyone to enjoy. For everyone that is listening in online, please do make sure that you type in your questions. We're having those moderated, and I will be answering them throughout the presentation. And of course, anyone that's here live, please feel free to chime in anytime. You don't need to worry about interrupting. If you want some more clarification on something, excuse me, please feel free to ask. As soon as it wants to advance the slide. My name is Alex Perny. I'll be your presenter today. I've been working with Advanta since 2012. I'm a certified IRA services professional, so I can answer a broad range of questions from anything from basic IRAs to defined benefit plans to 401ks, really anything that you have a question on, even if it's outside the purview of our basics course with this and pertaining to real estate and an IRA, please feel free to ask me. I am more than happy to help. And if you need to schedule a consultation, we're always happy to do that as well. Just a disclaimer before we get started, Advanta IRA and our employees do not provide legal, tax, or investment advice, nor do we endorse or promote any investment products. All information provided today is for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment structure. So in this series, we're trying to really build a good foundation of what it is to have a self-directed IRA, what kind of investments a lot of people utilize these for, and ultimately what exactly a self-directed IRA is. Now, last week, my colleague Scott Maurer covered this in good detail, but just to make sure that we recap, the term self-directed IRA generally refers to the ability of one to utilize their IRA in a manner that they determine themselves for investments that they go out and allocate and find themselves. So you're going out, you're doing the due diligence, you're finding the deals, and then making the investment happen. Self-directed IRAs can acquire real estate, hold mortgages and notes. They can also do private placements, precious metals, and a lot of other things. There really isn't any inherent limit to what an IRA can do past stocks and bonds like what we hold, but we'll get into a few of the different things that you actually cannot invest with here in a little bit. A little bit about us. We have well over 20 plus years of combined experience with self-directed IRA administration. We utilize a secured network of banks to hold all cash here at Advanta. Every single cash deposit you hold here is FDIC insured up to the applicable limits. And come on in. And we administer over $1 billion of assets for our clients currently. And we also utilize a good network of CPAs and attorneys. So for anyone that needs to get some financial advice, as we indicated, we do not provide any tax or legal advice. We can certainly make sure that that gets to you correctly. Now, if you have any questions going forward from this, we will be cataloging the recording of this presentation. So if you do have any questions going forward, you can go to our Advanta On Demand or our YouTube channel, and everything will be cataloged and recorded there for you. We maintain an up-to-date blog with all current industry and pertinent news, and we also host events such as this, whether they are live, simulcast, on-site, and off-site, with regard in the areas of both Atlanta and Tampa, where our two offices are located. But anywhere else in the country, we can certainly get you the web recordings for anything that we do that is digital. And again, coming out of this, if you do have any questions, please feel free to schedule a consultation. We're always happy to help. They're always free, and so long as it's during normal business hours, we can get those taken care of, typically same or next business day. Now, before we get too far into this, I encourage anyone online, if you have any questions that you'd like to get answered directly, you can go ahead and fire those off. Anyone in here have any questions before we get started? All right. So with regard to investing in real estate, now, investing in real estate can be done a myriad of different ways. There's really no one prescribed method for doing this, and neither is there a prescribed type of a retirement plan to utilize for investing in real estate. The primary focus of what you're going to need to do with determining which type of self-directed plan to choose is what type of plan you currently have. Now, all of these plans have their own merits, and they also have a lot of different considerations with regards to whether you're getting tax deductions for adding money in, or you're adding in money in on an after-tax basis. Now, most people will be familiar with the traditional IRA. This is because the majority of the majority of people in the United States have been adding money into plans on a deductible basis, meaning you get to add the money in pre-tax into an employer plan such as a 401k, 403b, thrift savings plan, governmental 457. The list goes on, but most of the time you're getting a deduction for the money you're adding in. Now, once you leave employment with that employer, you have some options. You can either roll those funds into a new 401k with a new business, or you can roll them into an IRA that you hold in your personal name. Now, in order to avoid paying taxes on that, most people will elect to put it into a traditional IRA. So that's what most people are familiar with. Now, there are some misnomers out there indicating that you have to have a Roth IRA to invest in real estate. Now, while the tax benefits of a Roth IRA are very attractive, there isn't anything that one of these accounts can do that the others can't. There are a few certain investment scenarios where one of these accounts might make more sense to do a particular investment in, but there's no direct prohibition of doing any particular type of investment in any type of plan. Was there a question, Scott? Okay. Now, the great benefit of the Roth IRA is that you get tax-free distributions once you have satisfied the requirements for that Roth IRA. What that means is that once the Roth IRA has been established for 5 years, you're of the age of 59 and a half, you are able to take any and all contributions and earnings out of that account completely tax-free. So everything that is accrued in that account, whether it's from rollovers from Roth type employer plans, whether it is your earnings off of contributions, everything gets to get distributed tax exempt. But the nice thing about all these plans is that it doesn't matter what your strategy is with investing in real estate. All of the income for any of these types of plans is just as exempt as anything else. So the tax benefit, or the current tax benefit of investing in a rental property with a traditional versus a Roth IRA really isn't too apparent, meaning that any rental income that you receive is all tax exempt, whether it's a traditional or Roth IRA. You're not tracking capital gains. So if you sell properties, maybe you buy and flip properties, you're not paying any taxes presently on either of those types of accounts, or really anything up here as well. So choosing the account needs to be more towards presently where you have your current funds at and what you're actually trying to accomplish with maybe contributions and small business plans as well. Now, contributions are a good segue because these plans' primary difference is the deductibility of the contributions and the amount of contributions you can make to them. With a traditional and Roth IRA, the most amount of money you can take out of your pocket of earned income in a given year is going to be $6,000 or $7,000, depending on whether or not you're over the age of 50 and a half. Now, that's not a ton of money. It's certainly nothing too small, but when you're talking about buying assets on the order of magnitude of expense with real estate, you might need a little bit of an extra push to get there. Now, if you're a self-employed individual or you have employment income from a business that you run, you might want to look at either a SEP IRA or an individual 401k plan. Now, with this being a basics course, I don't want to get too far into the weeds of determining exactly how much or how you determine the amounts that you can add into them, but the maximum contributions for both of those types of plans is in the low $60,000 mark when you are able to fully max out your contributions to them. So the ability to get closer to a cash purchase price with either a SEP IRA or an individual 401k plan is it's a lot easier to do than maybe with just starting from scratch with a traditional or Roth IRA. Now, although not as common, and certainly today's current market with a few reasons, health savings accounts and education savings accounts can also be self-directed. So if you have qualifying high deductible healthcare and you want to self-direct your HSA, your health savings account, in order to buy real estate, you can certainly do that. And then education savings accounts, the main reason we don't see a lot of those is the contribution limit is $2,000 per year for those types of accounts. So it is kind of hard to get those things to grow at a level that you need to invest in real estate. But just understand your options are not just limited to a traditional or Roth IRA. Really, any type of old employer plan that you have or current plan that you have can be self-directed. To everyone in the room, any questions so far? All right. Moving right along. So real estate, it's a broad term. It can encompass a myriad of different options that you have out there, including options, which we'll get into in a second. There are a lot of different ways to do this. Now, people have the misconception sometimes that you have to do one type of real estate investing, whether that is something that they've learned in a course they've taken, whether that's something that their neighbor has told them, whether that's something they read online. You can kind of throw all that out the window. I encourage people, do what you're comfortable with and that you feel you understand the best when it comes to investing in real estate. Your next door neighbor, your friend, your business partner might be fantastic at buying and fixing houses. They know how to identify things that need to be fixed. They know the market well. They can do it on budget and sell it for a good profit. But maybe you're a much better read of character. Maybe your area of expertise lies more in identifying good renters that are going to be in there, that are going to be able to pay for a long time, that are going to be treating your house with the care and respect that you need them to in order to be a good investment. So look at it objectively and understand that you can do what you understand. And that's one of the most powerful things about self-direction, is the ability to get into things that you feel most comfortable with, not something that's necessarily picked off of a list. Now, with regard to that, I mentioned renting. You can also buy and flip. You can also partner up with people. So if you maybe don't necessarily have enough money in your IRA to buy a property outright, you can partner with multiple individuals. Now, that can be done several different ways. You can do that in maybe a joint venture deal where you have, sometimes they're referred to as syndications. You have a lot of people coming together to pull their money together to take down a very large property. Most often we'll see that in multifamily or apartment investing. You'll hear the term joint venture and syndication used a lot if you do any research to that effect. You can also do what are called options, where maybe you sign a contract on a property to buy it in a certain amount of time for a certain price for a certain amount of consideration. Now, kind of threw out a few key terms for people that maybe aren't extremely familiar with it. Now, in the most basic sense, an option is a contract, but really what it most boils down to is the right, not the obligation, to purchase an asset during a certain period of time for a certain price. So you go up to John Smith and say, hey, I'd like to buy your house for $100,000 anytime in the next 5 years, and I'll give you $5,000 for the right to do that. Sounds easy. Well, let's say the market goes up. It goes crazy in that area. Now the house is worth $200,000. So you get to buy it for $100,000 and then immediately can sell it, hopefully if the market's good, for double what you paid for it. So that's a really interesting way to get in there as well. Now, a lot of people, especially if you're first starting out, and this might apply to a lot of you that are listening in, or maybe some people in this room, that you need to get the money out. Maybe you don't have a good network yet, or you just don't know people that you can partner up with. Wholesaling properties can also be a very good way to get into investing in real estate without having to have as much capital, either the purchase price or the repair prices of the property, to get involved. Now, what this is kind of the more basic version of options. You sign a contract to purchase a property. Typically, it's going to be a 30-day contract, and you put a deposit down, and then you go out and you try to find someone that's willing to pay more than what you have the house under contract for, and then you sell them the right to that contract. So let's say you have your IRA put in an offer for $100,000 for a property. You put $1,000 down out of your IRA. You find someone that's willing to buy that same property for $120,000. So you sell them that contract for an assignment fee of $5,000. So then you've made $4,000 on that deal, and then the other individual goes and closes on the property and pays $120,000 for the property instead of the $100,000 that you were going to. So, mix the math up on that a little bit. But essentially, you're getting the spread between what they're willing to pay for it and the deposit price on that. The other way you can get involved in real estate is by not being directly owning the real estate at all, and you can lend someone money for the purchase of that real estate. Now, this can be done in a lot of different ways, and I'd encourage anyone really interested in learning more about lending to attend our next Back to Basics course, which is going to be entirely focused on lending out of an IRA. It's going to cover everything from unsecured lending. So if you just want to lend someone a personal loan to themselves for whatever reason, doesn't have to be for real estate. You can have a secured mortgage in your IRA where you lend someone the money, they purchase a property, and just like SunTrust or Bank of America has the has the mortgage on your house. The IRA would be the mortgage holder in that case, and then you in turn would have the right to foreclose if they do not pay on that note. And then lastly, tax deeds and tax certificates. Another really great option for people that are looking to get started with maybe less than the amount to even partner with someone, because you can buy these incredibly cheap and they are secured by real estate. Essentially what you're doing is you're purchasing the right to collect on unpaid taxes from a particular county. So if a county has unpaid taxes on a house, they'll issue a tax certificate. You can go down and bid on these, and then you purchase the right to collect on those. Typically, they'll have a fixed interest rate of somewhere between 10 to 18%, and then you collect the fees and the interest that is being paid on that until it's paid off. Now, if they do not pay, the individuals do not pay that tax bill, you can apply for a tax deed, which will allow you to get the actual deed to the property. You're going to be responsible for any and all expenses such as other recorded liens, mechanics liens, and things like that to satisfy before you can sell it. But it's a good way for your IRA to get involved in real estate and actually make some pretty decent returns that are backed by the underlying real estate in them. Any questions in the room so far? Yes.
When you invest IRA money into buying a farmland and use the farmland to cultivate hemp, and a follow-up question, can the IRA invest in a medical marijuana dispensary?
Sure. So we got a good two-part question there. One is, can an IRA invest in farmland that cultivates hogs for agricultural purposes? Oh, hemp. Oh, I thought you said ham.
Oh, hemp.
For hemp. So you have two interesting questions there. So can an IRA buy farmland that is used for the cultivation of hemp, and then can an IRA purchase an interest in a medical marijuana dispensary, correct? So the answer to your first question is potentially yes. The hemp that would be cultivated on that land has to qualify under the I think it's the Farm Regulation Act for the percentage of THC that it contains to not be an illegal Schedule I controlled substance. If it is agricultural industrial hemp, then yes, you can do that. That's perfectly legal. The issue comes in the second question with investing in medical marijuana dispensaries. Now, because a lot of states are rewriting their laws to allow for this, whether on the medical or recreational side, that's all well and good. And depending on what state you're in, you might be able to personally do some investments. But the issue comes in with an IRA is that these are federally regulated accounts. And because the federal law still states that as a Schedule I controlled substance, any profits that are derived from an investment in that, you cannot deposit them to an FDI insured bank account. And you have the potential to have your IRA seized for illegal activities. Now, is the government doing this? No, but it's our job as the custodian and our regulated responsibility to, if we have a client knowingly doing that, not allow that investment to happen. So unfortunately, even though there are shifting views on that, you could potentially do industrial hemp, but if it was medical marijuana derivatives, that is something you would have to stay away from.
So the federal government approved the hemp bill as long as the hemp is converted into CBD, because it's not THC and it's legally allowed. Both state of Florida passed just last year, and I can give you the bill number.
No, yeah.
The government passed the hemp bill also.
No, exactly. Yeah, correct. For federal hemp, I would say your answer is more yes than no. I would and legally do have to say no, that you could not do anything that has a THC derivative for its profits in an IRA. But great question. That's certainly something that we're seeing a lot more of, and we really thrive on those alternative investments. We've had everything from people asking questions that we just answered to, can I do farmland for pig cultivation, or can I do breeding rights to cattle? We even had a client that had secured a note by emus on a farm. That was kind of an interesting one we saw years back. So that was pretty interesting. We have a lot of different things that you can come through, and we encourage the creative mind of our clients to come through, because if you understand something very well, and we had a client actually that came in that was very familiar with cultivating bamboo and set up a syndication of people to invest and grow bamboo to make products out of that. And I will tell you that I had no idea how many uses there were for bamboo until I kind of sat down and talked to them about it. But there are a lot of different things you can do. And past that, we have clients that do timber right harvesting and a whole lot of different things with real estate. You can even speculate if you want. You can buy raw land. You can buy a patch of dirt somewhere and then just wait for it to appreciate. And then some other cool things, especially in states that have high mineral content and things like that. You have states like Texas where people sell gas and mineral rights. They'll have wellhead leasing programs where if you buy a piece of real estate, you can lease the right for usage on the topsoil for them to put a wellhead there, and you get a portion of the profits back from that. So there's a lot of cool things that you can do with real estate in an IRA, and some of them are significantly cheaper than just going and buying a house directly. So how do you find these deals? Now, the nice part about it is that you get to use your own network to help increase the amount of money you can potentially make with your IRA. You get to use the people you know to invest in what you know. You're not going to go out and necessarily find a listed Advanta IRA that's going to say, hey, there's 123 Main Street being offered for $100,000. Who wants it? You know, we cannot provide or endorse or promote any particular investment deal over another, even if it is something that is as vetted as real estate. You're responsible for doing all of your due diligence, making sure that all of the criteria are met for that particular investment that you're interested in doing. And then once you've determined that that deal is a good fit, bring everything to us and we'll help you from A to Z with getting contracts signed, with getting everything done correctly in the name of the IRA. We'll make sure that's all done correctly for you. But you're the person that goes out, qualifies the deal, make sure it's a good fit, and then involves us in order to make sure that the property is closed correctly. Now, again, just to kind of enumerate on a few additional assets, you have one thing I see out there that's also relatively popular for people getting into this space is mobile homes and mobile home parks. Now, maybe not on the park end because those are very expensive, but especially local to our area here in the Tampa Bay area, the area of Lakeland and farther over into a few of the other counties have quite a few areas that have manufactured or mobile homes on them. Now, these can be a great way to get your foot in the door with real estate. You know, most of the time you are buying the real estate that is underneath of the mobile home. You can rent them out. Repairs are cheap. You can get the property and the trailer for cheap as well, and you can start making some pretty good cash flows. Now, with mobile homes, obviously you are going to be getting them for cheaper. They are going to rent out for less, and they might have some other considerations that you aren't going to see with more developed areas, such as the higher propensity to have things like septic tanks, which can be very expensive to maintain. And as we're going to show in a moment, any and all expenses from an IRA owned asset. So if you own a piece of real estate and it needs a new water heater, it needs a new roof, it needs to get painted, yard mowed, any expense incurred by that real estate has to be paid from the IRA directly. You cannot float or pay any type of bill for your IRA owned asset. Even if you did partner with your IRA, maybe you did a 50-50 split between yourself personally or another partner, your IRA cannot have its portion of anything covered by you. You have to make sure that you have enough cash in this IRA or in other IRAs that you can move over in order to make sure that those expenses are covered. So how do you pay expenses? Now, it's easy enough if you were to own this property directly. You would just get a call from your tenant, say, hey, water heater's going out, go inspect it, maybe try to fix it, and then move down the process of having everything done correctly to do it. And maybe you are qualified to do the work, but again, with an IRA, you are not allowed to do any of the work associated with that piece of real estate. So how do you do that? Well, you can certainly go and inspect to make sure, okay, well, my tenant's not just trying to get me to spend money on this place. You know, there actually is a reason for me to be out here. Figure out what needs to go on, find whomever you'd like to do the repair, so long as that they are not a disqualified individual. And we'll cover those in a moment. Now, a disqualified individual is basically going to be anyone that is a direct descendant of you personally, except for brothers and sisters. So if you have a brother that's a contractor or a sister, or someone that knows how to do the work, certainly able to have them do it. But your sons and daughters, mothers and fathers and spouses cannot perform any work on your IRA owned asset. So now let's say you've gotten there, you figured out the water heater needs to be replaced. You call John and Jane Smith Water Heaters LLC, and they say they're going to come out and fix it. It's going to be $500. So they give you an invoice, you send it over to Advanta, or you log on to your Advanta IRA online portal and then have us rip the check the following day. Or you can send us the invoice, and again, we'll have it paid the following day. Either ways to get it to us are just fine. And then we will have it sent directly to the individual doing the work. Now, some people may not want to be that involved with a property. You might want to be a little bit more hands-off, or just because of the nature of the rules with an IRA, you'd prefer to have a little bit more insulation between yourself and that asset. So some people utilize a property manager. Now, a property manager is someone that's going to field all of the calls from your tenants. They're going to take care of any maintenance issues. They're going to run everything by you. They're going to sign the lease for your IRA. They're going to put people in, kick people out if need be, and basically manage the property. So with that said, they take care of everything, and then they send your IRA just a net back. They'll collect the rent, pay any expenses, and then everything else comes back to the IRA. Now, if you'd like to use a property manager, again, that is fine, but we need to make sure that the property management agreement is written and signed by the IRA, is written in the name of and then signed by the IRA. This brings up an important point because with this, your IRA being the owner of a piece of real estate, this is a separate entity from you personally. Now, just as I said, you can't pay any of the bills personally, you also cannot do any of the work personally. So having the property manager stand in is great, but typically property managers are going to be somewhere between 7 to 10% of the total monthly rent in what they charge for that service. Now, depending on your cash flow rates, what you're actually looking to make as far as a profit, that can be something that you're willing to give up or something you don't think you're able to give up. But understand that you do not have to use a property manager. We do run into it from time to time where people believe that you are required to have a property management company step in, but you certainly can do it yourself. We have clients do it quite often. So who can't do the work? Now, again, any disqualified individual or yourself personally. But this is going to include everything. Now, remember, when I say everything, I'm not just saying, well, anything that's over a certain amount. It is going to be anything from painting the exterior and mowing the grass all the way up to replacing a water heater. So literally anything besides just inspecting the property to make sure that the work is done or there's not a huge issue cannot be done by yourself personally. Now, this doesn't mean that you have to go out there and hire the best 5-star rated contractor on Angie's List or get someone that is going to be super expensive, but you need to understand that it cannot be any disqualified individual. If you prefer to use a handyman or your neighbor or someone that you deem qualified for this, go for it. That is completely up to you, and that's one of the beauties of self-direction, is that we're not going to be sitting there looking over your shoulder saying, well, let's make sure that this person's license is valid. If you just need maybe some pressure washing done, or you just need a few walls painted, you can pay the kid down the street to mow the grass if you'd like. You don't necessarily have to, have someone as qualified as a professional lawn maintenance company come out and do your yard for your rental property. But it is important to note, and it's probably a good time to bring up, well, I hear him saying that all these things that I can't do. Well, what's the issue if I do them? What happens to my IRA if I do have a prohibited transaction? Well, it's very serious. And the most serious consequence for having a prohibited transaction happen within an IRA is that the IRS will deem the entire IRA distributable, essentially cancel the IRA as of January 1 in which the prohibited transaction occurred, which means that you will have to take the entire value as of then as a taxable distribution. So that's one, going to put you into a higher tax bracket. Two, you're going to have to pay a 10% early withdrawal excise tax penalty. So if you had a $100,000 valued IRA, that's $10,000 right off the top to the IRS. Plus your marginal tax rate will increase, and then you have to refile your taxes for every subsequent year. So is it worth it for going and painting your rental property? I would wager to say most people would think not. But it is something to keep in the back of your mind that, these are the consequences that they can potentially levy. If they figured out somehow that you had painted the outside of your house, would they do that to your IRA? Maybe, maybe not, but it is important to understand that that is a potential issue if you were to get audited and they were to see that you had been performing services to your IRA. Questions? Nope. Yes.
So then you can collect the rent, but you're not doing the maintenance of it.
It's a good question. So someone live here just asked, you can collect the rent, but you cannot do any of the maintenance. Correct. Now, when you say collect the rent, you cannot personally deposit it. You can go to the tenant and have them hand you a check and then drive it or mail it over here to Advanta. The key to that is you can't personally take possession of those funds. And it brings up another good point, is that if you're dealing with someone that, let's say, wants to pay cash, cash is one of those things where it's a bearer instrument, meaning that the person that holds it has the right to it. And if you put that in your hand, in theory, you have now just taken, you now possess, you own that cash. So it's important, and I tell people, don't accept cash. We do not accept cash here at Advanta. If they are insistent on using cash, maybe they don't have a bank account, get a money order. Places like Amscot and a lot of other places will do them for free. Or just figure something out to where they are not giving you cash or anything that is directed like that. You know, don't have them make the check to you personally, make it payable to the IRA. Those are the kind of things that you really need to watch out for with doing that. And we see it from time to time. It's not something super uncommon, but it certainly does happen to where we've had people walk in here with several $1,000s trying to pay some rent. Yes.
And the other question I have, can you direct your IRA into a business or franchise?
So we just had the question, can you invest in a business or a franchise with your IRA? The short answer is yes. The longer answer is that you really need to look at a lot of things with that, just to make sure it's a good fit, because sometimes those have a lot of ongoing expenses that your IRA would need to have enough cash to cover. But there isn't anything prohibitive of saying you can't invest in a business. You absolutely can. Again, yes, you could, but that it gets into even deeper kind of into the weeds of things that you would really want to take a close look at and get with a CPA or an attorney before going down that route. Yes.
So if you have a checkbook IRA, can you deposit the checks directly, or are you still supposed to do it some other way?
Sure. We just had a question of if you have a checkbook IRA, meaning that if your IRA is invested into an LLC or a trust, do you have to do the same deposit method? Now, I'm glad you asked, because in 2 classes, we are going to be doing checkbook control, so we'll cover that in great detail. But in that scenario, we're going to have a case study that we're going to look at specific to that. If you've structured your IRA in a checkbook fashion where it's invested and owns an LLC or a trust, and you are named as the manager, that entity is what needs to deposit those checks. So you as the manager can take possession of it, you put it into that bank account for that. The real key to remember and follow in that is that your personal funds, so your personal money market, Jane John Smith's personal joint banking account, that's what doesn't touch any of these IRA funds. So now, who can rent the property? Again, there's no prescribed thing that looks at saying, hey, this person, you can only rent to people 18 years old. Only people 18 years and older can sign contracts. But to say that you can only rent to certain people, we have clients that do everything from high-end rentals because they've purchased luxury condominiums, to people that do Section 8 subsidized housing. There's really nothing that says that you can't do the type of rental program that you would like to. Obviously, you need to follow any applicable state and local laws regarding qualifying tenants, discrimination. Everything that would go into that still applies to your IRA. Was there something online, Scott? With regard to that. So that's the nice part about it, is that if you understand, and let's say 3 2-family homes in a certain neighborhood that rent out for X amount of dollars, you can do that. You don't have to bring yourself completely up to speed on Section 8 subsidized. You don't have to learn how to rent luxury condominiums and stage them. Again, with self-direction, you get to utilize what you know to help make you money with whom you know.
The question came in online is, can you speak on using a trust account as a checkbook IRA? I know you just talked about it a minute ago. So can you speak on using a trust account as a checkbook IRA and a disqualified party?
Yes. So the question is that can I speak on using a trust account for checkbook control and prohibited individuals involved with them as well? And Yes, I can. And what I should probably do, I hate to kind of defer your question, not answer it right at a second, but I do have a slide towards the end that has literally answers that question, and we'll get a little bit farther into that here in a little bit. But yes, I can. You can use a trust to do checkbook control, and there are some considerations for disqualified individuals and their involvement with trust as well. But you'll get a very detailed answer here in a little bit. Now, the terms of the lease. Again, I keep saying it because it is very important. There are no IRS guided requirements for what the terms of the lease are. We have people that do things like VRBO and Airbnb. They do very short-term rentals, and because they have houses in very desirable places that have high vacation rental appeal. You don't have to do that, but it is a very interesting way to kind of supplement or increase the amount of income that your IRA is receiving for its property. Now we have some people that do long-term leases. Let's say you have a commercial property in your IRA, and you want to do long-term commercial leases. Really, whatever works for the tenants that are in there is going to be something that you can make work with your IRA. Now, a key to remember is that, again, your IRA owns this. The IRA has to sign the lease. One big issue I've seen with people is that they write the lease. There's no property management company. They'll write it, they'll sign it personally, and that would not be a valid and enforceable lease. And then they get into a lot of trouble if they try to evict someone, they have an issue with the tenant, because essentially that tenant never signed a valid agreement because the IRA didn't sign it, or a named property manager with the authority to sign a lease on behalf of the IRA did not sign that. So a very important thing, just like you cannot do the work yourself, is that if you are going to be renting the property, it has to be signed by the IRA if the property is not under management contract. And if you are utilizing checkbook control, as we alluded to with either a trust or an LLC, making sure that the named manager or trustee is the only one signing that contract and no one else. So those are really big issues. We've seen it with people unable to evict people for very lengthy periods of time, especially if you have even verbal agreements with people, although you may want to do things on a handshake basis, especially with an IRA. I can't recommend enough utilizing the proper legal channels to do things, have things in writing, have things properly signed by all parties. If you need to get something reviewed by an attorney, a half hour of an attorney's time or an hour of an attorney's time is going to save you a lot of headache on the backside if you do have an issue, especially with the degree of variance between certain areas' rental laws and others. For instance, if you're renting to someone in the state of California or Washington, it is going to be wildly different than renting to someone in the states of Texas or Florida, which have very different laws regarding landlord-tenant rights. So make sure you understand your local laws, make sure the property is being properly maintained, because if you are going to be renting it, the IRA is responsible and can be held liable for any issues with the property. So make sure you have good insurance for the property. Make sure your insurance agent knows that the IRA is the owner and that the property insurance policy is written to the IRA, or it is named as an additionally insured on that policy. All of these things are very important with regard to owning real estate outside of an IRA. They're equally important, if not more so, within an IRA, because these are going to be your retirement funds that are purchasing this. So just like you wouldn't have terrible insurance outside of your IRA, it's doubly important to make sure that you have it within the IRA as well. Yes.
You have a condo and the insurance is on the name of the condo association, and you have only one unit that's owned by your IRA. How do you make the insurance word in the IRA? It's not necessary.
Sure. So we had a question asking, if you own a condominium and the insurance for the condominium that your IRA owns is in a master policy for the condo association owners, how do you handle that? Well, that's handled right at the beginning. So in some condominium associations or structures with or conjoined structures that have an association that governs them, you will have a master insurance policy for everyone to protect, the person below, a unit below someone, if the other one floods, that they're insured, and making sure that everyone's equally insured for that. Now, with regards to that, when you go to closing, the reason you involve Advanta from the very beginning is that you'll have all of the documents that assign all of the interest to the IRA involved in that. So just as you would be personally insured by virtue of signing things that agree to the terms of the deed restriction on that property, it would then in turn extend that insurance coverage to your IRA. And there's really not much you would need to do just besides making sure that the IRA properly closes on the property for that. So who you can't deal with. We already briefly reviewed that, and we'll just go over it again. Mother, father, son, daughter, or spouse are people that you cannot directly deal with, meaning you cannot directly purchase or sell an investment to one of those individuals, and one of those individuals cannot directly utilize an IRA-owned asset. Now, with stocks and bonds, that's much easier. How do you utilize a share of Microsoft? Well, you don't. People never really run into this outside of self-directed IRAs because there's really no ability for them to do that. Now, what does this look like within an IRA? Well, if you own a rental property in your IRA, you can't rent it out to your children. I had an example of this with a client that had bought a property in Auburn, Alabama, and sure as enough, his daughters were both going to be going to Auburn as freshmen. He sent us a lease that had the daughters had the name of two women that had the same last name as him. So we asked him, hey, what are these people's relationship to you? And then he indicated they were his daughters, and we explained the rules to him. So those are things that you need to watch out for, as though even though you're not trying to maybe do something bad with your IRA, and you're still trying to rent it out for market rates and not deceive or violate any rules, you certainly can back into these things as well. So you cannot lease anything out to a child. You cannot purchase property. We run into this a lot of the times with older or elderly parents, and a IRA owner may want to purchase their property to either help them out with some more cash flows. Maybe they don't have much for retirement, or maybe they just think it would be a good investment and then let them keep their house and live there for as long as possible. Again, not trying to do anything bad, but these are the rules as they are laid out, and you do have to follow them. Now, this does extend to entities owned or controlled by disqualified individuals. So let's say that your son owns a real estate investment firm, and they have a rental property that LLC owns, and he owns 100% of it. You cannot buy that property from your son's LLC. If he owns more than 50% of it, that is kind of the defining mark of not being able to acquire that property in your IRA. Or if he owned a company that did contracting work, you could not have them come and do the repairs or the improvements on that property as well. You would need to get some type of third party. Again, doesn't have to be the most expensive person out there that has the most ratings on Angie's List. It doesn't have to be a licensed contractor, although there are a lot of inherent dangers and issues if you do hire someone that's unlicensed to do it. But that's not that's not for us to decide. That is for you as the IRA client to decide of how much qualification you would like that person to have doing those improvements on your property. Now, if you are going to be financing a piece of IRA owned real estate, you can do that. There are a whole class that we teach directly on that. It has to be non-recourse financing. And if you are going to be doing financing, you cannot personally guarantee the mortgage. You cannot extend credit to the IRA. You also cannot help with the down payment. Again, if the IRA is going to be buying something or taking out a loan to get something, it is going to be the sole entity named on any of those documents. And then lastly, the one that we run into every once in a while, let's say a wife had a 401k, rolled it over to a traditional IRA, and then bought a piece of property with it. And then let's say a little bit later on down the road, the husband left his job, had access to that old 401k, rolled his money over to Advanta for a self-directed IRA, and they wanted to hold the property 50-50 so that both of their retirement accounts could get built up. Well, the problem with that is that essentially that would be a sale of an IRA-owned asset to a disqualified individual. Even if they filed a joint tax return, even if they've been married when the property was acquired, these are separate entities from themselves. So to convey that portion of the property would constitute a prohibited transaction, but they could have done that if they had partnered from the outset. So if they had both brought their IRAs together, both had purchased it as a 50-50 tenant in common, they could have done that directly in the IRA without having any issues. So now, what do these deals actually look like? And it's kind of cool because this one really illustrates one of my favorite aspects of doing self-directed real estate investing. A lot of people like to point out that you do miss out on some tax deductions with utilizing IRAs to invest in real estate. And while that is true, one thing that you do get rid of is having to do any tax forecasting, meaning you don't have to take any cash from what you're currently earning on these properties, escrow it or set it aside for tax payments. You get to take all of the cash that's returned and invest it directly back into what you're doing. So in this example, John identified a property being sold as a short sale, so being sold in lieu of foreclosure, and has the offer accepted at $120,000. The deal is funded and closed directly in the IRA, and then he rents out the property for $1,200 a month for 2 years. Now let's assume he hit the proverbial jackpot and had 0 expenses. So he has $28,800 of rental income over that period of time. Now in 2 years, he sees that the neighborhood is greatly improved, so he decides to sell the property. He decides to sell it for $170,000, which is $50,000 of upside profit, plus the $28,000 and change that he got for renting the property out for 2 years. And again, let's just assume that this is a perfect scenario with no expenses. Obviously, he'd have to pay real estate taxes. He goes from having $120,000 at the beginning of 1 year, and at the end of 2 years has $198,000 to invest. Now, if you were doing this personally, you would need to carve out a portion of that $1,200 a month as a tax payment. You might have other liabilities that have to be paid with that as well. And then the $50,000 of upside profit, if you're going to be selling that within 2 years, could potentially be exposed to short-term capital gains, or if you have it for after that, long-term capital gains, but you're going to probably be losing about 15 to 20% of the profits that you have from the rents and the equity appreciation in that. But the more powerful example here is that he can immediately turn around and that $198,000, he can use all of it. He doesn't have to wait to make sure he's filed his taxes correctly, get a return, do any forecasting. He gets to take the money in, spend it on the property. The expenses are the expenses, the profit is the profit, and that's it. There's no tax return that needs to be filed for this. He goes out and makes $78,000 in 2 years, and that's all. He can immediately turn around and go from buying $120,000 properties to almost $200,000 properties without having to worry too much about really anything else other than just the numbers of the deal. Now, we've talked a lot about buying the property, what you can and can't do with the property, how you pay these bills. Now, some people, and we've had a couple of people ask questions, well, what about things like checkbook control? Now, the way this works is that the IRA, instead of directly buying the property, so the property being in the name of Advanta IRA for benefit of John Smith IRA, the individual that opens the account elects to start an LLC or a trust that the IRA will own. And then this acts as the holding company for the asset. Now, a lot of people like to refer to this as checkbook control because in an LLC fashion, the IRA owner can act as the manager and write checks directly out of that management account for paying bills for the LLC, acquiring the property, signing contracts, signing leases. That's where the term checkbook control comes from. Now, to circle back to the online question from Scott earlier, the trust can also do the same thing. It can be a checkbook control function, but the IRA owner cannot be the trustee of that trust. Now, a trustee of a trust and a manager of an LLC operate in the exact same paths. You know, they are the ones that sign everything with regards to each entity. So they sign checks, sign closing documents, sign leases. But in the difference between the two is that an LLC manager does not meet the required legal definition of a fiduciary, whereas a trustee of a trust does. That's a legal term for someone that is legally required to act in the best interest of the entity that they're representing. So a manager is not held to that standard, but a trustee is. And the IRS says that you cannot act in a fiduciary capacity to your IRA. So therefore, that is our business decision not to allow clients to act as trustee for their IRA-owned trust. But again, if you have any non-disqualified individual, so brother, sister, business partner, any of those kind of people can be the trustee of your trust. And we do allow for people to be the manager of their IRA-owned LLCs. And in our course, Teaching Checkbook Control for Back to Basics, we will be covering the legal doctrine that goes into confirming that as a valid way to do things. So how does it look if you're going to be buying property in an LLC or a trust? Well, both of them look pretty much exactly the same with regards to the mechanics of actually how they close, just with a little bit different of how these things are titled, and we just kind of give a little bit of a different example in how they're functioning. One real big benefit if you want to do things like property auctions or tax deed auctions is that checkbook control can be a real big benefit, because although we write checks incredibly quickly, we process things same or next business day. If you need to attend an auction, be there in person locally to you, and then write them a check in order to actually fund the investment, as fast as we want to work, we just cannot, unfortunately, administratively do that for you. So utilizing an LLC or a trust where you have that checkbook control will certainly enable you to do things that need that quick response time, like tax deed auctions, like property auctions, etc. So in this case, Rachel invests all of her Roth IRA into a single member LLC. So she invests into a checkbook IRA in order to attend property auctions. She buys a foreclosed property the day of sale for $100,000. So she goes to the courthouse steps, the gavel drops, she writes him a $100,000 check, and then she now owns the property. The total cost for rehab and to quiet any liens on the property is $30,000. Again, paid from by her IRA-owned LLC, not her personally. This is just an extension of the IRA. And as the manager, Rachel sells the property for $210,000. So after $130,000 in, she gets to take out $80,000, or she gets to collect back in the total of $80,000 in profit, and then everything goes back into the LLC, tax exempt for the next deal. The same functionality is achieved by a trust. Just again, you cannot act as the trustee, i.e. the manager for that trust. So Jim forms a trust under a SEP, so his business plan, to invest in a mobile home community. He directs his trustee, so he calls his trustee and says, hey, I want to buy this 30-lot park for $110,000 in the state of Georgia. So he immediately creates revenue from installment contracts on trailers and from the lot rent he charges on those trailers, meaning that he does rent-to-own programs with the people renting those trailers, so that way he can generate income back to the trust from that. And then the continual revenue stream of that trust is held, the continued revenue stream from that mobile home community is held by the trust and directed by the trustee going forward. So if he wants to invest in anything else, he just calls up his trustee and says, hey, I'd like to make an offer on this. Or if there's an issue with the mobile home community, the trustee then in turn just writes a check or engages with the property manager to get that taken care of. So that's the basics of real estate. Again, we want to make sure that we don't over encumber you with too much information on this. But the last thing I always like to give people is, how does this all get started? Because you can understand everything, but if you don't understand the basics of at least how to do this, then you're going to get to the closing table and then realize, hey, wait, I needed to open an IRA first instead of kind of starting this from the back and starting from the end and trying to work your way forward. So the first step in this process is to open an account. We need to get an account open so that no matter which way you're looking to go, whether you are signing the contract for the IRA directly, you want to invest in a trust or an LLC to do checkbook control, we need to have the account open in order to sign anything for your IRA. Think about it like an engagement letter for an attorney. We need to have at least it signed so we can start the work for you. You don't necessarily have to have the funds in the account, but we need to have the account open to sign anything. You then need to fund the account, because remember, any and all expenses, and that includes any repairs and all the closing costs, have to come from the IRA. So you need to move funds over from either making a cash contribution, so that's $6,000 or $7,000 of personal contribution, moving funds from another IRA, so having us submit a request to your current IRA custodian to move the funds over, or rolling funds over from a employer plan such as a 401k. Then once we have the funds, then we can issue any closing costs that we need to. So wire the proceeds to closing, we can invest in an LLC, we can invest in a trust, options, wholesale contracts, really whatever you'd like to do. At that point, once the account is open and funded, you're good to go. There really isn't any other applicable holds. There's no other saying, hey, you got to have the account open and dormant for a month beforehand. Once we have the funds here and they are cleared, you are ready to start investing. So that's pretty much what we have for our back to basics for real estate in an IRA. I'd like to open up for questions and answers for anyone online or anyone here live with us. Thank you very much for attending. Our next two in the series of back to basics with the self-directed IRA are going to be mortgages next and checkbook control after that. So if there were some more interesting points you wanted to learn about with regards to trust LLCs or investing in mortgages, please do stay tuned for those. We'll be doing those as one of them as a simulcast as well. So anyone local here that wants to come back, or everyone online.
Somebody just asked, what are our fees? What are your fees?
Sure. So it works out to just about $295 per year per property. That's really it. You're not going to have to pay really anything else because we don't charge you for checks. So if you need one check or 20 checks written for a property, that's all included in our annual record keeping fee. If you do an LLC or a trust, it's still the same charge. There's no additional charges from us on an annual basis for that. So great question, but we do try to keep that very competitive and make sure that you have as much of a potential to make money without having to worry about small nickel and dime fees from us. Any other questions for the people in the room?
Another question came online, just for sure. Are you guys what are called qualified intermediaries? Are we qualified intermediaries?
So what they're asking is, are we qualified intermediaries? What they're asking really focuses on what's called a 1031 exchange, which is something that is done outside of an IRA for doing tax-free real estate investing. While some people out there are, and they do that service, we are not qualified intermediaries, but you don't need to be a qualified intermediary to administer IRAs. They are exclusive to each other. An IRA doesn't do a 1031 exchange because it's already tax exempt. A 1031 exchange for a personally owned investment property is something that you do have to have a qualified intermediary for.
Another question, can you start an LLC on a property that is already in an Advanta account with shared IRA ownership?
So can you start an LLC to hold the ownership of an IRA-owned property that already has Advanta IRA accounts that own it? Absolutely. If you'd like to take that property that already has IRA owners and it's directly held by an IRA and move it into a LLC, you can certainly do that. Just have to get a quitclaim deed drafted by an attorney, get the operating agreement for that LLC set up, make sure all of the ownership percentages are clearly defined, and then move it right into that LLC. Not a problem. All right. Well, I think that pretty much sums it up for our presentation here. Thank you very much, everyone, for attending today. I had a great time doing our first simulcast, and make sure to join us back for the rest of Back to Basics with your IRA.